Today we are going back in history to figure out whether this parabolic move in gold tells us anything about the future of the economy and more specifically the stock market. Gold is a safe haven asset. When you see it go up like this for multiple years at a time and making parabolic moves to all-time highs, you need to be asking yourself questions. We're going to take a look at some of these similar parabolic moves that we've seen throughout history in gold and whether that could be an early warning sign of an economic downturn and so a potential sudden crash in the stock market. But first, we're going to go through 4 points that are very important to understand about gold and how it behaves relative to the stock market. We're going to switch over to a 100-year historical chart of gold prices to go through these 4 points. So point number 1, it is a safe haven. Gold does not pay dividends, it does not give interest, but it does keep its value over time. You can see on this chart, the long-term trend in gold is up. It's making higher highs and higher lows. And so gold is generally considered to be a great hedge against inflation. Point number 2, just like most asset classes, gold works in bull and bear markets. And you can see from this chart, these can be very powerful bull and bear markets. So you should not think that gold is not a volatile asset just because it keeps its value. This bear market right here took gold from $2,200 all the way to $400. This chart is obviously adjusted for inflation, so on the actual chart we're actually at all-time highs. Point number 3 is that in the short term, it can be heavily correlated to the stock market. And you can see this on this chart right here. This is the 2008 crisis. So even though gold was in a heavy bull market right here, we did have a significant drop in price throughout 2008 and 9. And that's very important to understand that if the stock market goes through a heavy bear market, gold will likely drop in price as well. And that's mainly due to margin. Our economy is very leveraged. And so when the stock market crashes, people need to sell their gold in order to pay back the leverage that they had on the stock market. Now, point number 4 is that you should drop a like on this video. That really helps us push this video to a larger audience and really makes our effort and research worthwhile. Now, over the long term, gold does tend to have an inverse relationship to the stock market. And that's exactly what we're going to be discussing in this video. So let's take a look at the bull market in gold from 1920 all the way to 1934 right here. Gold went from $200 all the way to upwards of $600. Let's see what happened to the stock market throughout that time. This is the chart of the Dow Jones Industrial Average. So it's a chart of the stock market going back to 1915. And you can see throughout that period, so 1920 all the way to 1934, the stock market was pretty much flat. Now let's take a look at the second bull market of gold. It started in 1970 right here and ended in 1982 right here. This was a huge, powerful bull market in gold. It went up from $200 all the way to $2,000. So it went up tenfold in a matter of 10 years. So let's compare that to the stock market. The stock market was here in 1970 or 1969, right before the gold bull market, and it was here in 1980. So again, the stock market was pretty much flat throughout this period. Now, what is happening right now in 2020? What is happening with gold and the stock market now? So let's go back to the gold chart, and you may have noticed a pattern in the way gold behaves throughout its bull markets. You tend to have a leg up, then a sideways consolidation for, this was 4 years, and then you have another leg up. And we had the same thing in the 1970s. We had the first leg up right here. We had a sideways consolidation for around 2 years, and then the second powerful leg up. And so in 2020, this is pretty much the same pattern. We have a leg up right here. We have a leg down for 3 years. This was 2012 and it bottomed in 2015. And we've just taken out the all-time high. So we're starting this next leg up that is likely going to take us much higher. So we are continuing the gold bull market. So let me know in the comments down below if you want a video covering fundamentals on why we believe that gold has so much more upside left to go. And let me know in the comments below if you want a video covering the actual fundamentals, why we believe that gold actually has much more upside to go. So now let's get to the important part. We're gonna clear the chart here and we're gonna compare exactly what happened to the stock market those specific years where gold continued its second phase of the bull market. That happened in 1930, right here. This was the year 1930 where gold took out this high right here. And this was 1978 right here where gold took out its high from right there. So let's go back to the Dow Jones and see what happened in 1930 and 1978. So the year 1930 was right here, and it's pretty obvious what happened from that point on. The markets crashed, I think around 80%, we can measure it out from here, 84% from that moment on. So anyone who put their savings in gold at that moment made the deal of their lifetime, because gold kept its value. It actually went up, and once the market was cheap, you could have gotten back into the stock market. And now 1978 is a little bit less obvious. Year 1978 was right here. So just seeing this like this, it's not too bad. The market was flat for a few years and then it started the bull market right after. But if you know your stock market history, you'll know that the year 1978 all the way through to 1982 were 4 years with massive inflation. And so every year you were in the stock market and the stock market was flat like it was, you actually lost 10 to 15% of your investment. So the inflation adjusted chart for the Dow Jones throughout that period actually looks something like this. So a big drop in value. So in both cases, we've only got 2 data points, but in both cases, gold did warn of an underperforming stock market. And that brings us to the big question of the year for 2020. Everyone knows that the stock market is unlikely to be safe over the long term, over the next 10 years. But are we going to see a big deflation that brings us down all the way through here? Or are we going to see a stagnant stock market with high inflation, just like we did in 1978 to 1982. Now, if you learned something new, don't hesitate to drop a like on the video and let us know whether you think that we're going to see a big deflation first, or we're going to go straight to high inflation with the massive amount of liquidity that's being injected. Now, we believe that the stock market is going to go through a big deflation. And we think that we're going to revisit the 10,000, 12,000 point range in the Dow Jones. And I know we're going to get comments saying that's absolutely crazy, but do not underestimate a deleveraging economy. An over-leveraged economy, just like we have now, that goes through a deleveraging can be very, very violent. And we saw this in 1929, a very similar pattern with 2 consecutive recessions back to back, then a big pump with monetary easing, and then a deleveraging. And I'm not going to go into details on why 2020 is similar in terms of fundamentals, but if you're asking yourself questions like why is the stock market at almost all-time highs after a multi-month shutdown of the entire economy, then you've pretty much figured it out. We'll likely end the bull market with a blow off top and probably a melt up due to the excess liquidity that we've seen over the past few weeks. And then once people figure out that stocks are not profitable over the next few years, people are going to cash out. Now, of course, this is our view on the markets. This is our own research-based opinion on the market. So do your own research before investing. If you enjoyed the video, make sure to drop a like and subscribe to the channel if you have not already. In the meantime, good luck on your trading and see you next time.